Not every day we get somebody of your stature, Neel, so thank you very much for joining.
Thanks for having me.
Now you're in the hot seat. We're going to start off with a question maybe of education. And so the Federal Reserve, it's this mysterious organization. We wonder about its powers, its structure. Can you talk a bit about the mission of the Fed and why the mystery around the Fed exists?
Sure. Well, first of all, thank you for having me. I really appreciate it. The Federal Reserve is our nation's central bank. So our jobs, we were created by Congress in 1913. Our jobs are to try to manage some of the ups and downs of the economy. So if the economy is slowing down, typically you'll see the Federal Reserve will cut interest rates to make it cheaper for you to get a loan to try to stimulate economic activity. And if the economy looks like it's overheating, we'll typically raise interest rates to cool things off. Now, if you go back in American history, Alexander Hamilton created the first central bank for the United States. That's part of what made him so famous. That lasted about 20 years, and Congress got rid of it. It sounded very mysterious and very nefarious. Then they created another one, then they got rid of it. Then the US economy was hammered with financial crises. And then Congress finally said, even though we hate the idea of having a central bank, because it sounds nefarious, I guess we need to have one. But if we're going to have one, let's distribute it around the country. So let's build checks and balances into it. So that's why you have what's called the Board of Governors in Washington, D.C. You've probably heard of, way back when, you probably heard of Alan Greenspan or Ben Bernanke or Janet Yellen or now Jay Powell, the current chair. And they created 12 independent regional Federal Reserve banks, including the Federal Reserve Bank of Minneapolis. So the reason I'm here is because our jobs at the Minneapolis Fed are to represent all of you. We need to know from you what's happening in the local economy so we can bring this back to Washington, D.C.
Right. So the Fed chair and the Fed directors are appointed by politicians. Talk about the relative independence of the Fed versus the politicians who govern our country.
Yeah, so
how does that work?
One of the foundations over the last 30 or 40 years, Republicans and Democrats figured out that if they kept the Fed independent of day-to-day politics, we would make better decisions. And that actually goes back to our original structure. So those people in Washington that I talked about, Ben Bernanke or Janet Yellen or Jay Powell, they're appointed by the President of the United States and they're confirmed by the Senate. You've seen the Senate confirmation process can be somewhat unpredictable. And I was confirmed by the Senate in 2008 when I was at Treasury. But Federal Reserve presidents, the 12 regional bank presidents, we are not appointed by the president. We are appointed by local leaders. So we have a local board of directors, and that is by design because Congress said they don't want the president to be able to control the entire Federal Reserve. That's why these regional banks are appointed by local leaders. So that's part of the checks and balances built into the system to keep it separate from politics.
Okay, very cool. So 2018, let's step back in time 10 years. So you're at Treasury, you're a relatively young guy. All of a sudden you're thrust into running the TARP program, I think a $700 to $800 billion program for the United States. What was the most difficult decision you had to make during those very dark times?
I think the most difficult decisions were just shielding all of the noise. Right? We were getting inundated. Members of Congress, everybody was angry about the financial crisis for good reason. The crisis was deeply unfair. Millions of people were affected by it. Everybody was angry, and a lot of them were directing their anger at us. So it was an easy decision, but it was the most difficult part of the job, was shielding all of that noise and saying, you know what, we are just going to make decisions based on economics. We're not going to let politics creep into our decision making. So, for example, in the program that I ran, in about 6 months, we had hired 140 people. We had to build this program from scratch. Everybody we hired was non-political and nonpartisan, 100% of them, because we wanted to make sure we were making decisions for the right reason. So that was the hardest thing to do, but we also knew it was the right thing to do.
Right. At that time, obviously, at the beginning of the crisis, big decisions. Do you let certain banks like Lehman fail? Do you save others? What was it like inside the Treasury at that point in time? Because it's from the outside, it was obviously very turbulent.
Yeah, from the inside, it was very turbulent too. It felt like, I've never served in the military. It felt like the economic equivalent of 9/11. That the U.S. economy was under attack, maybe from within. It was just chaos, and we were trying to sort it out and figure out, given certain tools, what can we do and what should we do? As Americans, we are all allowed to do whatever we want, unless whatever we want to do is prohibited by law. So the presumption is with you. If you want to move to Texas, you can move to Texas, but thou shalt not steal. Certain things are prohibited. The executive branch of government is the opposite. the executive branch of government is only allowed to do things that Congress has said, you may do the following. So the presumption is against you. So we had our lawyers going back to statutes from the 1800s, looking for some authority somewhere to give us the tools to intervene. And so trying to make sense of this chaos, given a limited tool set, was also very challenging.
Right. So I remember one of the narratives back then was too big to fail. Dodd-Frank passed. People have tried to go after that. Fast forward to today, banks are bigger today than they were back in 2007, 2008. So what's your feeling on the position of banks and the relative risk they pose or don't to the broader economy?
Well, the biggest banks in America, just as you said, Kurt, are bigger than they were before the crisis. They're still too big to fail. I mean, lots of people want to say that they're not. They are. Don't let anybody kid you. Now, they are stronger than they were before. They have more capital. That means they have more skin in the game to protect themselves in case they make mistakes. But if they were to get into trouble, you and I would be on the hook again, because if we allowed them to fail, they could bring the U.S. economy down. So at the Minneapolis Fed, we've put out a very aggressive plan to try to address this. The challenge is the political winds right now are blowing in a deregulation mode, right, when we need more regulation for the biggest banks.
So you ran as a Republican for the governor of California. You just mentioned that deregulation is a bad thing. How does that harmonize?
Well, I didn't exactly say deregulation is a bad thing. Those weren't exactly my words, but they were close. Well, so my view is, I was appointed by President Bush in a Republican administration. I believed in free markets. I still believe in free markets. I believe markets make better decisions than regulators. Right. But I also learned that markets can make very big mistakes sometimes. And sometimes those big mistakes can be devastating for the rest of us. So we need some appropriate guardrails to prevent things from going over the cliff. And that's what our plan does.
Okay, very cool. So you mentioned Alexander Hamilton. Obviously, great playwright, as we know these days. Super interesting guy. If you've never read biographies on Hamilton, what would he think of banking and the economy and where we are today?
Well, he was the inspiration behind many of the economic structures we have today. So one of the things, I think he'd probably say we've taken it too far. I'll give you an example. One of Alexander Hamilton's pioneering ideas was to take all of the state debt of the individual colonies and federalize them to unify the country behind a national debt. Now, that has unified the country, but we have a heck of a lot more debt today than I think he probably would have imagined a couple hundred years ago. Right. So I think he'd be proud of the U.S. economy, but say maybe we've taken a few of these things too far.
Right. So debt, if you think back to 2007-8, you had the consumer credit bubble that burst. And you can argue whether governments or banks contributed to that. Fast forward to today, the credit bubble is more of a public credit bubble, which is that governments have borrowed at an ever-increasing rate. What risk does that pose? And will countries continue to just print money to get out of that cycle? How do we resolve that over time?
This is a big, long-term political challenge. It's how do we decide as a country, how do we reach consensus on how much we want to tax ourselves and then what we want to spend that on. No country can live beyond its means forever. So our U.S. government debt position is climbing every year. We're now at the highest debt level as a country as we have been since World War II. So the challenge is, what do we do about it? Right. And our society is aging, and we're having fewer kids. So the ratio of workers to retirees keeps going down, which makes this debt problem bigger and bigger and bigger. So this can go on for quite a while, but we know it can't go on forever. Mm-hmm. And somehow we need political leaders to come together and reach consensus. I don't have a very good answer for you. It's not an immediate crisis, but we know it's a long-term issue, but it's fundamentally a political challenge.
Yeah, my children don't know it yet, and they're 15 and 17, but they don't like the fact that we're borrowing against them. So let's broaden the lens. Let's look globally. There's things in the market like Brexit, the trade wars or tariffs that we're seeing, especially between the US and China. Oil prices are beginning to escalate a bit. Geopolitical tensions are simmering. As you look at the economy and you look at, for example, interest rate decisions that you make, what are the key things that you consider? And I know it's an infinite number of factors,
Sure.
but how do you make those sort of very subjective calls?
It is. I'm glad you characterized it that way. These are subjective calls. I wish this was an exact science. It's not. We're making judgment calls. So they're all the international issues that you just talked about that we try to factor in. We try to weight the probabilities of a trade war versus some emerging market crisis. But we also spend a lot of time looking at the U.S. domestic economy. And a big question we've been asking ourselves over the past few years is, are we really at full employment? Right? One of our goals is maximum employment, as many Americans who want to work are able to find jobs. Well, if you look at the headline unemployment rate, which is now 3.9%, that would suggest everybody who wants a job is able to work. But we've been wrong for the past couple of years. We keep saying we're at maximum employment, and then 200,000 people per month are coming out of the woodwork taking jobs.
Right.
So probably where I'm spending most of my time, and this is why visiting businesses like Carlson is so important, is trying to get a sense of, are we really there yet? Are you able to find more workers? Are you having to pay your employees more? I know they want to say, they want you to say yes. Are you paying up? Those are.
I'm starting to sweat here. I'm in the hot seat now.
So exactly, we're turning it around. These are the things that we're really trying to assess. Is the economy running at full potential? Is it running above potential? Is it running below potential? That's really what guides our decisions.
Right, right. So you, tariffs, trade wars. Typically, Republicans have been the party of free trade. Democrats have been the party that's closer to protectionism. It seems like that's, not that the Democrats have been in that position, but Trump has run on a populist sort of campaign and put in certainly protectionist measures. What's the near and the long-term impact on a free market economy like the U.S. when you go to change those trade restrictions?
Sure.
When you do that?
Well, near term, we're not seeing anything yet in the data from the tariffs that have been imposed. We hear a lot of rhetoric. A lot of businesses that I meet with are anxious about it, and they're nervous about making investment decisions, but it's not yet showing up in the aggregate U.S. economic statistics. Right. Long term, it could be very damaging for the U.S. economy if we're really in a full-fledged trade war. The U.S. economy has benefited tremendously from free trade over the last 100 years, you know, developing technology, selling it around the world, et cetera. At the same time, we do need fair trade. And I think anybody objectively looking at our trade relationship with China, nobody would conclude that this is fair trade, what's been going on for the last few decades. So I'm sympathetic with what the administration is trying to do to push China to level the playing field. But at the end of the day, free trade is in our interest, and it's in the global economy's interest.
So notwithstanding the rhetoric, the policy decisions are rational. Maybe the rhetoric's a little bit over the top.
So far it's been pretty minor in terms of the actual effect on the U.S. economy.
Okay. Why don't we have a lot of smart people here in the room, I know. Why don't we turn it over to the audience for questions they may have?
Super. Anything you'd like. There are some microphones there.
Hi there. I've got a question about just the changes with NAFTA to the USMCA. What's the impact of that specifically?
It just happened last night, so I don't know the answer to it. I mean, my guess is it's probably pretty minor. Okay. My guess is these are minor tweaks, just from the headlines that I've read, affecting certain sectors of the economy. In aggregate, NAFTA has absolutely helped the U.S. economy grow. We know there are distributional consequences, right? Individual workers, individual businesses are affected. I don't yet know what it's going to mean for individual sectors of the economy. But I'm happy that they reached a deal. I mean, a deal is better than no deal. And so I feel good about that.
Think it'll pass Congress?
Again, I don't know what's in it, but my guess is I think Congress understands that trade is important for the U.S. economy.
So quick, on the back of that, in the sort of the Titanic negotiation between, I'll call it Germany, the EU, but we'll call it Germany and the UK with Brexit. How screwed is the UK in that negotiation? Because Germany is a tiger economically.
Germany's a tiger, but I also think the EU needs a relationship with the UK. I mean, I think Great Britain or England is important for the rest of the European economy, and so it's a tough negotiation because on one hand they want to be really tough to try to prevent other countries from leaving. On the other hand, if they're too tough, then that's going to fragment their own economic relationship with the UK. And so I don't know yet how this is all going to play out.
Right.
Neel, thanks for coming in today. Quick question about the current state of the economy. A lot of indicators right now are flashing green. What keeps you up at night as you look at where we are in the cycle, and what do you think the biggest concern should be in the minds of the other Fed governors as they're assessing where we're at today?
Well, the biggest concern that I have, you're right, most of the economic indicators are flashing green. Job growth is strong, wage growth is picking up a little bit, overall economic growth is strong, but the bond market is sending us flashing yellow signs, saying, hey, it may not be all roses looking ahead. And this is something that you may read about on the press called the yield curve and the shape of the yield curve. And basically, as we raise interest rates, we raise the borrowing cost for the US government, Treasury borrowing rates. But then the long-term borrowing rates, when the Treasury borrows for, say, 10 years at a time, those rates are not moving very much. That tells me that the bond market is saying, hey, we're not so sure that US economic growth is going to be very strong in the future years. So that's a nervousness for me. And so what I'm paying attention to is, are we overdoing it with our interest rate increases? So for me, whether the yield curve literally, historically, this relationship, and sorry I'm getting technical, has been a very good predictor of recessions if we invert what's called the yield curve. I look at the yield curve as a measure of giving us feedback as, are we running accommodative monetary policy or contractionary monetary policy? And I don't see any reason yet that we should be moving interest rates up and tapping the brakes. So that's probably what I'm most focused on. And I know several of my colleagues around the Federal Reserve are also paying attention to it.
Quick theoretical question. So
Sure.
The equity markets have been red hot for a very long period of time. My layman's view of that is because interest rates are low, therefore returns with fixed income are very, very low. Therefore money floods from all these institutional investors into the equity markets. And that holds the markets up. If interest rates were to go up, fixed income would become, which is bonds, et cetera, become relatively more attractive. So are the equity markets being artificially inflated by the low interest environment?
Well, this is a key thing. What interest rate represents neutral, that neither stimulates the economy or taps the brakes? We're not exactly sure. You'd think we would know, but this is an inexact science. And over the last 30 years, interest rates in all advanced economies have gradually been trending down. Right. That's not the result of central banks. That's the result of broader macroeconomic forces. So it's very possible that, you're right, equity prices are elevated because interest rates are low, but interest rates may not be low just because of the Fed. Mm-hmm. They might be low because of broader macroeconomic forces that will keep them low. Right. And so you may not end up seeing a repricing because the neutral rate may actually just be low.
Right. And you mentioned tapping the brakes on interest rate rises. That's a little bit counter to what the broader Fed has been doing. How do you, what's that process like? What's the, sort of inside the circle? How does that decision happen?
Well, we meet 8 times a year in Washington, D.C. for these Federal Open Market Committee meetings. They're 2-day meetings on Tuesday and Wednesday. All of us get together, the 12 presidents and up to 7 governors, if they're all seated at the time, meaning they've all been appointed. And we each take turns going around talking about our outlook for the economy, the data that we're looking at, what we're seeing in markets. And then on the second day, we each give our recommendation on what we think policy should be. And there's a vote. And the presidents rotate on who's voting. So I was a voter last year. I'm not a voter this year, but we all give our economic intelligence. But the chair, who was Janet Yellen and is now Jay Powell, as chairman, they have a lot of influence, as you might imagine. And they kind of guide us and try to drive consensus around the decision. So ultimately, it's a consensus-driven approach where you have a lot of people, smart people who are doing their best, trying to make the best decisions they can.
Hey, Neel, just curious if you set aside the impact on the market or any impact on the market, what your view of the impact of the new federal tax laws had on the economy, specifically on business investment and wage growth?
Well, we're not, business investment has picked up, but most of the pickup, from what I understand, has been in the oil sector because oil prices have risen. And so there's a lot of investment in North Dakota, and in Texas, as an example. So far, it does not seem like the tax cut has led to a huge uptick in business investment outside of the oil sector, maybe a modest uptick. And we're seeing a modest translation from the tax cut into wage growth. Wage growth right now is still around 2.9% per year, which is well below where it was 10 years ago. And it's low, the way we think it works, if the job market gets tight, Kurt and his competitors are going to have to compete with each other to find workers, and they're going to have to bid against each other, and that's going to drive up wages. We're not seeing a big uptick in wage growth so far, so that tells me we're probably not really at maximum employment just yet. So I think it's early. I think overall GDP growth has been stronger than perhaps we would have guessed. But it's easy to generate GDP growth if you spend more money. The question is, when the tax cuts wear off and the fiscal stimulus passes, is the GDP growth of the U.S. economy boosted for the long run? That right now is unclear.
So I think you already kind of answered my question, but I was just wondering what you thought the reason why wage growth wasn't increasing as the rest of the economic indicators, and is that just solely exclusive, just that you think we're not at maximum employment at this time, or are there other factors that would contribute to that?
That's the number one factor in my mind, that we're not really at full employment yet or maximum employment. We also know that globalization is a factor, so businesses can say, well, if I can either pay more for workers here, or maybe I can turn, using technology, send some of this work to India, for example, or to China or to Vietnam. That's a factor. So technology and globalization, we think, are affecting it. Those are probably the two biggest things that I see right now.
A better question.
Let's get a mic. Hold on.
Mike's coming up to you.
So my question is, do you think if the UK would have allowed Barclays to buy Lehman, if that would have made a difference? And was that the right choice from a global perspective versus a UK perspective?
Sure. So going back in time 10 years, there was a negotiation that Barclays was thinking about buying Lehman Brothers in the middle of the financial crisis. And would that have helped? That would have helped the U.S. because Lehman would not have then failed. There would have been a way to save Lehman. But it wouldn't have done anything for all the other investment banks. And basically all of the major independent investment banks were failing one at a time. And so if there had been some way of band-aiding saving Lehman, it wouldn't have done anything for Merrill Lynch, wouldn't have done anything for Morgan Stanley or Goldman Sachs. So I think it would have just delayed the ultimate reckoning that we had to face. But on the margin, it would have helped a little bit.
Hi, thanks for being here.
Hi.
So earlier you mentioned the aging population and how there's going to be a disparity between the amount of people who are retired versus the workforce. And I've heard that immigration is going to be a key factor in filling that void. And so I was going to ask your opinion on how you think current immigration policy is going to affect the future workforce.
Well, I like the way you posed the question. This is a math question. We know one of the sources of economic growth is simply population growth. More workers to produce things, more consumers to buy things, and our fertility rate has gone down. We're having fewer kids. So our population growth rate is slower. So I always say to people, you have three choices, and you can decide which of these you want. You can either accept slower growth, you can try to subsidize fertility. This is what Japan is trying to do. Tax credits and free childcare is very expensive. By the way, it takes a long time to grow a new worker. Or you can embrace immigration. Those are your three choices. And so that's the math. Now, I'll tell you this. One time I said those three choices to an audience somewhere in the 9th Federal Reserve District in one of our neighboring states. And somebody said, you know what? I like slow growth. Slow growth sounds pretty good. Usually, when I say that, people will say, hey, you know what? Immigration doesn't sound so bad. So it's a huge competitive advantage for the U.S. that we're not perfect at it. We're just better than anybody else at welcoming immigrants, integrating them in our society, and people want to come here. So we'd be crazy not to use that competitive edge that we have.
Just to follow up on that question, there was, you talked a little bit about full employment, and that's a role of the Fed. In the Twin Cities, there's been quite a bit of hand-wringing, I think, about this idea. Do we have enough talent to maintain our strength as an economy, given that we are kind of a regional hub? And so curious on your thoughts on that, what you're hearing from other business leaders, and what's the Fed's role in helping us make that case here in the Twin Cities area?
Well, it is, so you're right. It's a huge issue in the Twin Cities. Why do we have so many great companies here? Part of the reason we have so many great companies here is we've got a lot of talent. We have very good schools. We have good universities that help educate our young people so they can become productive workers in all these great companies. But we're running out. And so we do need more folks to be here. But that's where, Kurt mentioned it, and I think Diana mentioned it, that we do a lot of research at the Minneapolis Fed on economic disparities. So Minnesota has a lot of stuff going for us, great schools, great economy, but we also have big gaps. We also have very big disparities. And if we can find a way to close those gaps, then we're going to bring more workers into our workforce, which will be good for them, good for their families, good for our region as a whole. So I think there are two elements to it. One is more immigration is going to be part of it. And second is making sure our economy works for everyone. where everyone can get that education, participate, and be contributors to our economic growth.
Neel, if you think about Minnesota specifically, which is a relatively high-tax state, if you look at high-tax states, I live in New Jersey, New York, California, they've been suffering population declines, and lower tax states such as Florida, Texas have been growing their populations. So how do you sort of, in a world where raising taxes will be very difficult, competing against other states, but there's a need to sort of bring people into the middle class, how do you solve for both of those things?
I don't think it's just about money. I mean, for example, if you look at our education, we've got huge education gaps in Minnesota. We have some wonderful schools, but then in certain areas we have some terrible schools. And so one of the things, Minnesota was the birthplace of charter schools, which many of you probably know. Minnesota also pioneered something called open enrollment to help kids get access to higher quality schools. That's an important element. I heard a statistic that in North Minneapolis, 50% of the African American families send their kids to a different school than their neighborhood school. That's profound. I mean, that's evidence that parents want better outcomes and better opportunities for their kids. Right. So I think the more that we can do to empower parents with information, with knowledge, with access to better schools, that isn't necessarily about more money. It's about getting them access and giving them the information that they need.
And that's a big political hot button, is public schools versus, say, charter schools, and the funding of those two different elements. And the Republican and the Democrats have sort of different views on that. Carlson's very active in promoting alternative and new forms of education, and very positively. How do you think about that from a Fed perspective in terms of what you try to promote or influence?
Well, we are actually getting pretty involved in education, because education is such a key driver of employment outcomes. Right? People who have more and better education have lower unemployment. Whether it's a booming economy or a recession, the fact of the matter is you're way better off if you've got more education and a higher quality education. So whether people like it or not, I consider it our business. And the Minneapolis Fed has done a lot of work for many years on early childhood education. We continue to do that. We're starting to get more involved in looking at K through 12 and even higher. In fact, we have a conference coming up in a few weeks just on education, bringing education experts from around the country to say, what could we do better here in Minnesota? I want us to take on the most important issues facing our communities. And I want us to do it in a nonpartisan, non-political manner, just looking at data and analysis, and let that lead us. And that's what we're trying to do.
Does data and analysis lead the federal government? Sorry, that was unfair.
Sometimes.
Hi, as you talk about education, your initial career was engineering. Does that engineering mindset, guide you or give you an approach different than somebody else might have?
I think so. It's funny. I was an aerospace engineer for a few years before I went back to get my MBA, and then I went into finance, and then I went to Treasury. When I got to Treasury, I found that I used my engineering more than I used my finance. Because ultimately, what do engineers do? It's problem solving. You have a problem, you have certain tools, you have to unravel the problem and figure out how to try to address it. That's what engineers do. And that's what policymaking is all about. So I think engineering is great training for anybody, whatever you ultimately want to do. And I'm proud to, I work with a lot of economists, I like economists, but I'm proud to remind them that I'm an engineer.
Hi. So right now the economy is kind of going on with current policies, and we seem to be going pretty good as far as the upcoming holiday season is concerned. Now with the upcoming changes with the tariffs, what is your advice to the businesses when the new tariff policies come and hit us?
Well, it's hard. I think it's going to be very business specific, right? Some businesses that we've met with have said, I've been wanting to raise prices for a while, and now I can. So they're using the tariff as an excuse to tell their customers, hey, it's not my fault. I got to raise prices because of the tariff. So I think each business is responding differently to it. Some businesses are directly affected by it. Some are just marginally affected by it. So it's hard for me to give advice across the board. I think more than anything, businesses want certainty. So the sooner we can get to whatever the tariff is, if it's 0 or if it's 5% or 20%, the sooner they know and they can design for it and they can plan for it, I think the better off everybody's going to be.
So we've had sort of a very interesting change in society where big tech has spurred innovation and growth like no other time. It's almost like the second industrial revolution. one of the concerns that has been raised as a public policy issue is the automation of jobs at an exponential rate. How do you think about that? And you've even had these classic serial entrepreneurs who developed these businesses, became billionaires, who were saying you should tax the broader economy to compensate for this, because you may displace people from jobs, even though when they were developing their companies, didn't necessarily want to pay money to the government.
Right.
What's the risk to the country and the economy with big tech sort of automating at an ever-increasing rate, and how should we think about that in terms of public policy?
Well, I'll tell you, I'm pretty skeptical of some of these doom and gloom scenarios. Innovation has been going on for all of our country's history. And when people brought automation to farms, they said, oh my gosh, this is the end of labor. Well, then people moved into factories and moved into cities, and the nature of jobs changed. So I expect job change is going to continue, and this is going to put a premium on skills and continuing to develop your skills. It's not simply go to college and then go work for your career. It's how do you continue to invest in your own skills, to develop new skills and to arm yourself. So I think change is going to be normal, but I don't think it's going to be the end of labor. And that leads down the path of something called the universal basic income, where, hey, a few people work, they produce all the wealth, and then everybody else collects a check. I'm not in favor of that. I don't think that actually ends up making us happy, fulfilled people as citizens in our society.
Right.
Just wondering your thoughts on the local economy and the minimum wage increase in Minneapolis.
Sure. We at the Minneapolis Fed, we're proud of this. The city of Minneapolis picked us to do a long-term study on the economic effects of the minimum wage. So, there's a couple schools of thought. One school of thought is you raise the minimum wage and you make it more expensive for businesses to find workers. And if you raise the price of something, you're going to get less of it. So that's going to end up hurting people because they're going to be fewer jobs available. Other people say, no, it doesn't have such an effect. Now, right now, the economy is strong. Businesses are having to compete for workers. So on the margin, there should be less downside risk right now than if you were to raise the minimum wage at a time of high unemployment. So I think on the margin, this is a good time to do it if you're going to do it. But it's too soon to judge. In some other cities that have raised their minimum wage, the workers who kept their jobs were better off, but then businesses cut their hours. And so their take-home pay maybe wasn't any better off. So, it sounds easy and good on the surface, but it ends up being pretty complicated. So we're doing it, I hate to tell you this, we're doing an 8-year study. It's going to take some time for us to figure out what are the real economic effects of this.
Got a question about the kind of another regional question in the economy on the housing market. Right now in Minnesota, we've got higher increasing prices in housing, low supply. What's the long-term and near-term effects of that?
Well, the long-term effects are directly, we were talking about the availability of workers here in the Twin Cities and in Minnesota. It's going to be a direct hit to our economic competitiveness relative to other states. It's going to be cheaper and easier for people to move here to move elsewhere than to move here unless we address this. I'll give you an example. I visited a manufacturer in Duluth, and I met their CFO, and he had just moved here, and he said, my gosh, Duluth is so much more expensive than where he used to live. And I thought, where did you used to live? Must be some little rural community. He lived in Houston. How can Duluth be more expensive than one of the biggest American cities? Well, we have imposed so many barriers on new supply coming in that all we're doing is pushing up rents, and we're pushing up housing prices. And so NIMBYism, not in my backyard, is like a cancer that we all contribute to. And we have to fess up to that, to our own role in that. And unless we address it and allow people to build more supply, we're never going to be able to address this problem. And then it's going to come down to our economic competitiveness.
So I struggle with this. So long-term growth rates generally are supported or helped by lower tax rates. As you raise taxes, growth slows down. So in a world where we want to have healthy growth to create employment and so forth, but where the debt level is so high already, and the government is spending more, the federal government, more today than it ever has historically, how do you solve the issue of taxes versus debt? Because if you tax more, the growth rate will slow down, and therefore eventually the denominator doesn't grow at the same rate.
Right.
How do you solve for that? Because spending, I think, and I'm going to get the number wrong, something like 80% of spending is Social Security, Medicare, Medicaid, and the defense budget.
Right.
There's like 20% other discretionary stuff. So how do we attack this?
Yeah, there's only two ways of attacking it. One way is you need more people. Full stop. If we open the immigration doors and said we're going to bring in more people from around the world, and you can design the system however you want. You can design it to be purely skills-based. You pick. But we have more people, the math changes directly by having more people. And second, we need more productivity growth. And that means more R&D and more education. And so it matters what we spend on. Right. If we're spending on the right things, that can help boost productivity growth, which can also make the math better. Hi.
Hi. I'm going to switch gears a little bit from jobs and talk foreign currency.
Okay.
What's your perspective for global organizations like CWT and many of our customers whose financial performance can be dramatically impacted by foreign currency fluctuations, and what can be done to potentially mitigate that risk a bit sooner?
Well, I don't know that there's anything that can be done other than having your own hedging strategies to try to manage your foreign currency exposure. I recognize that it's expensive probably to do so, certainly to do so year after year after year, and if there are long-term trends in currencies, you can only hedge so much. But a flexible currency regime is one of the hallmarks of our global economy that we live in. It's better to have, I think, this flexible currency regime where currencies are able to adjust for different macroeconomic fundamentals. Part of the reason the dollar is strong right now is because the U.S. economy is relatively strong, stronger than other countries. It's stronger than Europe, and it's been exceeding expectations in many ways. And so I think that that's a good thing for the U.S. We want the U.S. economy to be strong, but that means there's going to be currency movements, and each business is going to have to try to hedge those risks or accept those risks depending on its own characteristics.
Luckily, we have a great treasury function here. So.
I'm sure you do.
Neel, as you look at the broader market globally, name somebody, each in the private and the public sector, who you admire that's a leader.
Public and private sector that I admire. Well, one person, I'll call her out because she just retired from the Fed. It would have been disingenuous when she was still there. I admire our current chairman tremendously, but I also admire Janet Yellen, our former chair, who retired from a great public policy service, a career of public policy. So great admiration for Janet Yellen. Somebody in the private sector that I admire, well, that's tougher. There's so many people who get a lot of attention, like Elon Musk, who creates great products, but then they also
there have been a few issues there.
There have been a few surprises. Or Steve Jobs creating all these great products. He also had his own.
In fact, Diana told me that I should not tweet Stone. That's a bad idea. As Mr. Musk has done recently.
I think there are a lot of good businesses that are doing the right things for their employees and for their customers. I think Minnesota has a lot of them. This is a remarkable, I'm new to Minnesota, moved here about 2.5 years ago. Remarkable to see in Minnesota a business community that is as civically engaged as it is. I've never seen this anywhere else. Right. Grew up in Ohio, lived in California, have moved around a lot, but I think that this is a real hallmark that the business community in Minnesota is so actively engaged, and I think that's a real strength.
So, and you've been in a position where you've run for political office, you're in appointed offices, notwithstanding the fireworks in Washington, D.C. last week, people that are in the public eye now are subject to ever more scrutiny, and in fact, you could argue it's the politics of personal destruction, especially at the federal level, impacts people, and that's even people running for Congress, et cetera. How are we as a society going to get good people to want to run for office prospectively in this environment?
I read a lot of American history, and the more American history I read, the less freaked out I am, because I think most of our country's history has been one of political upheaval. And if you see what politicians 150 years ago faced, and the nasty things that were said about them, and what the press wrote about them, it's not so different now. The news cycle may be a lot shorter today than it was 100 years ago or 200 years ago, but it's just as harsh. It was harsh back then, and it's harsh now. So I think we get through it. I think our political system is messy and unpredictable on average, but I think it finds a way to work.
Yeah. There's a terrific book, which is written by William Safire of the New York Times, called Scandalmongers, which is about the founding fathers, and the political environment then was actually infinitely worse than it is today. So as you think back on history, who do you think is the most underappreciated character in U.S. history?
Well, it's hard to pick one, but the person that I have become a huge fan of is President Ulysses S. Grant. Chernow, who wrote the famous Hamilton book, just wrote a biography on Grant. I've read a bunch of books about him in that era. Not only was he an inspiring Civil War general who helped lead the winning of the Civil War for the Union, he was actually a very forward-leaning president, two-term president, that was decades ahead of his time on civil rights. I mean, literally decades ahead of his time on civil rights as president. And so he's somebody that I think we don't have as much. When he was president, I mean, he was larger than life. He was an amazing figure that you wouldn't realize today had such a large presence in the U.S. So I think he's underappreciated today.
Okay. Questions?
I got a question on deregulation. You know, seeing what happened in 2008, I think a lot of it stemmed from the housing deregulation policies, right, with the Clintons or in the 90s. With the current administration, is there any deregulation on, you know, certain specific areas that most concern you?
Well, so far, I mean, I'm mostly focused on the financial sector. The big banks are where I find the most concern, that if we were to walk back regulation. So Congress passed a banking reform bill this spring that walks back regulations on very large regional banks, but it basically doesn't touch the biggest banks, so that's the biggest dozen or so banks. So that's net positive, but we know the big banks are now trying to set up their chance to get their regulations walked back. So far, no, but that's where I'm paying close attention to try to speak out if it seems like the big banks are going to get a break. Yeah.
So we operate in what I call a mature sector, travel and business travel. And you know, we have to constantly be on edge to satisfy the legacy demands of what we do, but then be innovating. As you look across the economy, what do you see with companies that have been around for a while? What did they need to do to be able to grow and thrive long term?
Well, I think it's hard for me to give you advice about this because you're already doing it. I mean, I think it's finding more ways of adding value to your customers, and it's getting the best employees you can and giving them equipping them with the best skills, the best tools possible to be as productive as possible and to come up with those innovative ideas. You know, at the Minneapolis Fed, we're tiny compared to you. We have 1,000 employees, but we're always trying to look across our employee base and saying, what are your ideas? If I'm responsible for coming up with all of our good ideas, we're doomed, right? We need to tap into all of our employees and say, what are your ideas on what we could be doing smarter or better or more efficiently? And so I think the companies that do that, tapping into all of their expertise, are ultimately going to be most effective and most competitive.
So one of the biggest levers we have is empowering and really tapping into the talent, which is massive across the organization. Flip that, if you're looking at people earlier in their career, in their 20s, 30s, even old people like me, what would be your career counsel to them in terms of how they should think about the way they engage, the way they manage their professional life?
Sure. I've done a lot of different things: engineer, banker, policy, running for office. There's never been a plan. For me, it's always been pursue something that I'm interested in and do my very best at it. And if I do that, doors will open. So whenever I give people advice, I say, just crush your job. Whatever your job is, if it's senior or junior, you work in the cafeteria, you work in marketing, do a great job in what you're doing so that you become the go-to person for your team. So that if there's a new project that comes in, your manager says, I got to give it to you because I know it's going to get done well. That's going to lead you to get more responsibility. That's going to open doors for you, and that's going to lead to good things. People have said, well, shouldn't I spend time networking? I've never spent any time networking. I always just spend my time focused on what I'm supposed to do and do my very best at it, and that leads to more responsibility.
How do you run for governor without networking?
Okay, fair enough. I did have to do some networking. Well, then again, I lost, so maybe that tells you something.
Maybe you ran in the wrong state.
Maybe I ran in the wrong state.
Anything left from the audience?
Yeah, I have a question.
Hi.
Thank you so much for being here.
Absolutely.
There were so many great things and questions you talked about this morning and answered. I'm wondering, 10 years after the crisis, what is the one message, if you could choose one, to tell the American people in the markets about where we're going and what's at stake?
The one message is we will forget. If you look at the history of human civilization, it's full of financial crises because we have these what I call mass delusion events. Like we believed, I bought a house in California in 2005, right? We believed in 2005 that home prices only go up. That was a mass delusion event. And when it was proven to be wrong, it was devastating for the US economy. But we keep forgetting these lessons, and it's our kids or our grandkids who then repeat the same mistakes. So we are going to forget, but while we still remember, we have to try to put in place some guardrails to protect us from ourselves. When we do forget, these guardrails will hopefully be there so that we don't drive off a cliff.
So how close are we to the next recession?
Well,
inquiring minds want to know.
There are quite a few market commentators. We look at a bunch of different economic statistics to try to estimate this, and they're not elevated right now. On any given year, there's around a 15% chance that there's going to be a recession next year. It's just the way that, just the odds. It's just like rolling the dice. So right now, the indicators are not particularly elevated right now, except for that one indicator of the bond market in the yield curve flashing a yellow. And so there are risks in emerging markets. There are risks of trade wars. And there's the risk that we at the Federal Reserve just raise rates too much. That's the risk that I'm most focused on because it's the one that hopefully I have some ability to try to influence to try to prevent that from happening.
Follow on to that. Do we have the guardrails necessary so when we do have a recession, do you have the power and the tools that you need in order to fix it?
So this is a good question. Typically if the US economy hits a recession, historically the Federal Reserve would cut interest rates by about 5 percentage points in response to that to try to boost the economy. But right now, interest rates are much lower than that because that neutral rate that we talked about earlier is much lower than it was, say, 20 or 30 years ago, which means if we try to cut rates by 5 percentage points, we hit zero. So you may read about it's called the zero lower bound. You can't cut rates anymore. Well, that's why the Fed then in the last crisis embarked on what you probably heard about quantitative easing, where we ballooned our balance sheet to try to drive down long-term interest rates. We still have that tool available. And we have other tools we call forward guidance. Part of the way economics works is what you think is going to happen in the future affects your decisions today. So if we tell you, hey, we're going to keep interest rates low in the future, that actually can be stimulative itself because you'll say, okay, well, now's a good time to buy that house or to make that investment because rates are going to stay low. So we have a number of different tools to try to combat future recessions, but maybe not as powerfully as we did 15 years ago or so.
Neel, you talked earlier about some of the toughest decisions you had to make in 2008. Just curious, what was the darkest hour from your perspective, kind of getting an inside view on what was happening?
I remember, well, there are a few things. A few times I thought I was going to lose my house. So I told you I bought a house in California in 2005, and my salary went way down when I went from the private sector to Treasury. So I was paying my mortgage out of my savings, and my savings was all in a money market account. And I said, oh my gosh, all the money market accounts are going to be hosed. I'm going to get hosed because I'm not going to be able to pay my mortgage. I'm going to lose my house. So I thought briefly about transferring my money to my checking account because I thought it'd be safer. Now, I didn't do that because I felt like I had inside information on what was happening and it wouldn't be fair. So I said, if the money markets go down, I'll be with millions of other people losing my house too. So I had that thought, a few different times. There was one night I remember I was sleeping in my office working 16, 18 hours a day, 7 days a week. One of our economists came in literally crying that the financial system was collapsing right now. What are we going to do? And I said, all we can do, which is what we can control. We have to get our programs up and running as quickly as we can. And if the financial system collapses, then we'll figure out how to put it back together. And that's all we can do. And so, we had a great team of people working together. I'm really proud of, but there were some very dark moments.
But the policy book for how to do that was thin.
The policy book was incredibly thin. I mean, we were basically making it up as we were going along, and we didn't know if we would be successful. Sitting here now, it's a miracle that our interventions worked as well as they did. At the time, they were just our best shot, and we didn't know if they were going to work.
So what gives you hope with our short-term and long-term economic outlook?
The hope is that the U.S. economy is more competitive and innovative than any other economy in the world, and it's not even close. People worry about China, and I say to you, name one thing that China has invented in the last 100 years. And don't say gunpowder, because that's like 5,000 years ago. Okay? You can't name it, and I can't name it either. And think about all the great companies. How many of the great companies of the world were started in America? I mean, it's disproportionate. I mean, most countries are thrilled if they have one national champion great company. We have dozens and dozens and dozens. And so something about the US economy, our education system, our legal system, our culture is unbelievably advantageous. Our ability to bring talent from around the world here and integrate them and help them start businesses and contribute to businesses. So long term, I would never bet against us, and I would never bet in favor of somebody else. We do have our short-term challenges that we need to tackle, and that's coming up with political consensus to tackle these challenges. But I'm really bullish on USA long term.
So Neel, you've been a rocket scientist, a banker. You've been a candidate for governor. You've been a public servant in the Treasury, now the Fed. What's next?
Wow. Well, I'm very happy at the Fed, very happy in Minnesota. It's a wonderful place to live. I hope I'm at the Fed for a long time. I'll tell you the one thing, and this comes back to your own background, the one thing that I feel like I missed in my career, because I've done a bunch of different things, is I've never served in the military. And I feel like that is a void in my experience set that I would love to have had. And I
Private
think
Kashkari. It's got a nice ring to
Sure.
it.
I was hoping captain maybe, but okay. You could say that's fine too.
We all start on the ground floor.
I understand. We all start at the ground floor. But I think that's something I could have benefited from and learned a lot from.
Right. Well, Neel, it's been a privilege, and really do appreciate it.
Thank you very much.
Thank you so much.
Really appreciate it.